Dugan. He's Chief Investment Officer at Dalma Capital, a global investor. Thank you so much for joining us, Gary. How are you thinking about this fresh piece of stimulus against what has been wobbling economic data out of China?
Yes, absolutely. It is welcome. It's long overdue. Markets have been on an edge for at least for the last 3 or 4 months waiting for this stimulus. We don't believe it's the only stimulus that the Chinese authorities will do. We believe it's going to have to be more because they need to instill a lot more confidence into the economy. And it's starting with a real bang in the property sector, which clearly has been one of the big drivers of the economy in the good days.
There are other soft ways it's taking place. We're seeing perhaps they're lifting their foot off the necks of Chinese tech companies a little bit. But as you mentioned, perhaps these measures in the real estate sector to delay loan repayments is just the opening salvo. How big of a bazooka are we talking about, for lack of a better word?
Well, it's important because the property, and if you haven't got a vibrant property market where people can't trade or buy their new properties, then the consumer feels pretty down the mouth. And what we've, for example, we've seen a lot of good news recently, for example, of Chinese households going on their first trips abroad in some considerable time. But the new fact is that they're not spending as profitably as they've done, which suggests that general lack of confidence has to be addressed by the authorities, and this is a good start.
The Hang Seng, the Chinese market, the CSI 300, under pressure, has not kept up with global returns elsewhere in Asia and Europe and the US. Do you expect that to change?
I think in the near term, I think the problem that the market's got at the moment is that a lot of the longer term structural investors in China have disappeared. So what you've got at the moment, quite frankly, are more the day traders, which could easily run this market up between 5 and 10% on further flow of good news. But in order for us to go back to the peaks that we saw back in October of last year, we would need to see, I think, a significant improvement in the general sentiment around Chinese policymaking, and that may take some time.
And there's also, as you mentioned, kind of a broader trend of nearshoring, friendshoring that is perhaps a bit more of a structural issue for China at this time?
It is, but I think, the export sector is important to China, but it's not the total story. What we need in China at the moment is a lot more domestic demand, a lot more domestic confidence, and that, I think, could have a longer term, more positive impact than some of the concerns about the China's losing out in global markets.
For a long time, it has been USA all the way. That is where global investors have sought to outperform consistently. 2023 is one of the first years in a long time that you have seen outperformance, from Japan, from over in Europe as well. Where is the US ranking for you in terms of dollars to work?
Well, it's coming down, but it's not going down very fast. I think a lot of people just want to say this is the year of the demise of the US market. But that US economy is far more robust than many other parts of the world at the moment. So I still believe it'll get its lion's share of capital flows. But Japan's a standout. Japan, we believe, is seeing significant corporate change, a huge shift in the way in which company management think about investor returns through share buybacks, dividend increases. And that, I think, means that Japan could be a real stellar performance and significantly outperforming the US market, although the US market will still be a significant part of global flows.
I guess you can't escape sort of the AI play dominance that is in the US markets, but it's in other parts of Asia as well.
It is, and I think it's often forgotten that a good element, I think actually I've seen some numbers suggest the majority of the AI theme could be played out in the emerging countries. Maybe some of those companies are not always quoted in stock markets, so you don't get the same bang in terms of those domestic indices. But it's not just about the US, it will be a global phenomenon.
The US dollar weakening has been supportive for international markets and allowing them to rally. What is your outlook for the US dollar going forward, and how much of your optimism about equities abroad, outside of the United States, I should say, hinges on this kind of subdued US dollar?
I think subdued is the right word. I'm not so sure that the dollar just keeps disappearing down, another 5 or 10% downside from here. Not with the current economic policies, and particularly the monetary policy of the Federal Reserve. We expect the Fed to increase interest rates still further. I think if anyone's going to come off the brake quicker, it could be places like Europe, where we're starting to see very clear signs of a mini recession underway, which would bring the central bank probably back from further significant increases. And in doing that, could end up with the euro under some pressure. And in Japan, I'm not so sure they want tight monetary policy particularly quickly either. So I don't think the dollar falls very much further from here.